We talked about closing entries for a service company. The good news is for a merchandiser, they're really just the same. We have a few new accounts that we're going to have to deal with here. For example, we have sales and cost of goods sold that we have to close out. Remember, for a merchandiser, the first closing entry closed out revenues. Revenues have a credit balance, so we close them out with a debit to revenues and a credit to income summary. For a merchandiser, it'll be just the same. But what is the merchandiser's primary revenue account? Sales. So when you close out revenues, just remember that sales then is a revenue. Second closing entry for a service company, closed out expenses. Expenses have a debit balance. We close them out with a credit, and my debit then goes to income summary. How about for a merchandiser? Same thing, but what is the new big expense account that the merchandiser has that a service company did not have? Cost of merchandise sold. Good. They could have some other new accounts. They could have like delivery expense, for example, also, but that's just really a normal expense. So the only one which is kind of tricky is cost of merchandise sold, gets closed out with all of the expenses then. The third and fourth closing entries will not change. They are identical to a service company. So remember, in the third entry, it was either a debit to income summary and a credit to retained earnings, or reverse that depending upon whether you had a net income or net loss. And then the fourth entry was the debit to retained earnings and a credit to dividends. None of that is going to change them. Let's do an example. Here are all of our accounts. Which of these accounts are we not going to close out? Will we close out cash? No, cash is an asset. Don't close it out. How about merchandise inventory? Will we close that out? No, that's an asset. Don't close it out. All right, if you're not a Star Wars person, the Millennium Falcon's a spaceship. We're going to pretend it's a building to us. Do we close out building? No, that's an asset. How about accumulated depreciation? Do we close that out? No. How about accounts payable? Do we close that out? No, we wish we could, but our debts, unfortunately, just don't go away like that, do they? How about common stock and retained earnings? Do we close those out? No. Do we use retained earnings in the closing entries? Yes, but do we close out retained earnings? No. When is the only time we will close out retained earnings? When we're going out of business, and that is not going to happen this semester. So will we close out dividends? Yeah, that'll be our last entry. Will we close out sales and interest income? Yeah, those are my revenues. That's going to be the first entry. How about cost of merchandise sold? Will we close it out? What type of an account is cost of merchandise sold? An expense, so we'll close it out in the second entry, right? How about all those other expenses? Will we close them out? Yes, also in the second entry. So we are not going to close out cash down through retained earnings. We will close out all of the remaining accounts. My first closing entry closes out revenues. Revenues have a credit balance to begin with. What sort of revenues do we have in this example here? Sales and interest income. Good. Well, since revenues have a credit balance to begin with, if I need to get them down to zero, then I am going to debit sales, debit interest income, and I will make one credit for the total, and it goes to income summary. Debit my two revenues to get them down to zero, credit income summary for the total. Closes out revenues, RE. The second closing entry then closes out what? Expenses. We have a lot of expenses on that list, don't we? Most of them had the word expense in the account title. That makes it easy. There's one account that is an expense that does not have the word expense in its account title. What is that? Cost of merchandise sold. Good. Now, all of those expenses have a debit balance to begin with, so how will we close them all out then? With a credit. So if you would skip the debit line, the first line in the journal entry, and then we've got lots of credits here. We're going to credit cost of merchandise sold because that's my expense. Lots of other expenses here. Why are we crediting them? Because we need to get these expenses down to a zero balance, and they already have a debit balance. Now notice in this case I had 6 expenses. You could list these in any order in the journal entry. Doesn't matter what order they're in, as long as the one debit comes before any of the credits in. But the credits can go in any order. We're going to add them up, make one debit for the total, and that debit goes where? Income summary. REI, third closing entry says close out what? Income summary. What do we have to do before we can make the third closing entry? Do a T account for income summary. I did not give you one of the handout. Just on the side, I want you to draw a T account. Let's post my first 2 entries. The first entry was a credit of $126 to income summary. The second closing entry was a debit of $77 to income summary. That leaves me right now with a $49 credit balance in income summary after we post the first two entries. What does that number 49 represent? It is my net income. And how do I know it's income? Well, I had more revenues than I did expenses, so the difference is in net income. I have a credit balance of 49 in income summary. How will I get that account down to zero then? With a debit to income summary, and my credit goes to retained earnings. Now, after we make that entry, we think about it. We had a net income because we had more revenues than we did expenses. Crediting retained earnings does what? Makes retained earnings go up. Why is that? Earning a net income makes my retained earnings go. Finally, I'm going to close out dividends. Dividends have a debit balance to begin with, so I'm going to close them out with a credit to dividends, and my debit goes to retained earnings. Now my books are closed. They're ready for the next accounting period. The revenues, expenses, and dividends all have a zero balance. The only accounts that still have a balance are my assets, my liabilities, and my capital, and my retained earnings account balance now is up to date.